No problem, thank you.
So thanks, Katie. I'll just pass over to you to start introductions, if that's okay.
Perfect. Thank you so much. So hi everyone. Big warm welcome from me. My name's Katie. So I'm one of the business development consultants here at Chase de Vere, who's assisted in setting up this webinar for you today alongside the LMC. So big thank you to Charlotte as well, who's assisted in setting up this webinar for you today. We're delighted to be joined by Francesco Benava, who's an independent financial advisor here at Chase de Vere, who will be delivering the webinar for you today on what a GP needs to know about their pension in conjunction with the LLR LMC. We've also got Ish Prashar, who will be answering any questions along the way for you. I'm sure you're all familiar with the chat box function on Teams, so please do feel free to pop any questions throughout the presentation in the chat box function. We'll try to answer as we go along. However, we will probably answer a few at the end if we don't have time. The presentation will probably it'd be about 45 minutes or so. So we'll have ample amount of time right at the end of the presentation to answer any of your queries. There'll also be an opportunity right at the end. There'll be a QR code on the screen for you to arrange a complimentary meeting with our independent financial advisors that are here today with us. And I'll also pop a link in the chat box function for you all as well. So thank you very much. And without further ado, I will pass straight over to Franco to deliver the presentation for you all. Thank you.
That's great. Cheers, Katie. So obviously we've got today's presentation understanding the basics of your pension as a GP. And this is what today's agenda is going to look like. We're going to be looking at the legacy scheme. So whether you are in the old two legacy scheme, well, technically one scheme, the old legacy scheme or the new 2015 scheme, which all of you will be in from 22 at the very minimum. We'll be looking at the McLeod judgment, which will only affect you if you are a part of either of the legacy schemes. We're looking a little bit about what the 2015 pension actually means for you and how kind of that is structured for you moving forward. Then you'll be looking at what taxes pension tax is going to be available for you to pay as GPs, and obviously, minimising that as much as possible. Then we'll kind of talk a little bit about income protection, how that kind of is really one of the most important things that you can look at. And then we'll start talking you through a little bit about Chase de Vere, who we are, what we do, and also how we can help you. And then there'll be some time for any questions and answers. Like Katie said, Ish is on the call with me. He's going to be kind of going through, and if there are any questions that come through on the chat box, he's happy to answer them. And if there's any more that need to be asked at the end as well, I'm happy to answer those at the end for us. So, the legacy scheme. It closed, like I said, it closed for good on the 31st of March 2022. That doesn't mean that you are no longer in the legacy scheme, but it closed for good on March 2022 due to McLeod, after the McLeod judgment had been enacted. There are two real sections of the legacy scheme. You've got the left-hand side, which is the 1995 section of the scheme, and you've got the right-hand side, which is the 2008 section of the scheme. They are both what's called final salary pensions. Final salary pensions, in essence, mean for GPs, it's really slightly more like a career average earning scheme. So, in essence, what happens is they will take all of your income over the years that you've worked as a GP within the NHS. They will add all of that together. That will be increased. Those incomes will be increased by CPI plus 1.5% over the years. They will take that large figure at the very end and they will multiply that by 1.4%. That 1.4% is in essence what your pension will be when you come to retire. With the 1995 scheme, the retirement age is age 60. You will get an automatic lump sum of 3 times what your pension is. And also you did have the ability, no longer anymore, unless you had a contract already in place, but you did have the ability to purchase added years within the 1995 section of the pension scheme. The 2008 section of the scheme, it works in very much the same way. They'll take all of your income, they'll dynamize it upwards using CPI plus 1.5%. They will add it all together at the very end, and they will multiply that by 1.87%. And that, again, will be your pension that you will earn when you do come to retire. Slightly better accrual rate, which is great. Reason for there being a slightly better accrual rate is you've got a slightly higher retirement age of 65 rather than 60, and you also don't have any automatic tax-free lump sum. So, in essence, that's where kind of give with one hand, take away with the other. You do still have, however, the ability to purchase additional pension. If you are part of the 1995 or 2008 schemes, you will be subject to, you'll potentially rather be subject to the McLeod judgment. This will affect you if you are part of the either 2008 or the 1995 scheme prior to the 1st of April, or 31st of March rather, 2012. If you weren't part of the pension scheme before that date, the McLeod remedy doesn't affect you. But let's talk through what it actually does mean for you. Okay, it removed the age discrimination that was judged for arisen in public service pension schemes. In essence, it was deemed as age discriminatory to force everyone to move into the 2015 scheme when it was introduced in 2015. So to ensure equal treatment for everyone, all active members of the NHS pension scheme from April 22 are now in the 2015 scheme. And also, if you were part of the McLeod judgment, all of your service between the years of 2015, April 2015 rather, and March 2022 is now being moved. It will have now been moved into your legacy scheme, whether that be the 2008 scheme or the 1995 scheme that you are a part of previously. How are you affected? Like I said, you must have been serving before 31st of March 2012, and you must have been still serving on or after the 1st of April 2015. This includes all members who are active, deferred, retired, and anyone with a qualifying break in service of less than 5 years. In theory now, what should have happened is those 7 years of service should now be reflected in either a latest total reward statements, or I am aware that GPs do tend to be about 12, 18 months behind getting up-to-date actual documentation, etc., from the pension scheme, purely because you've got PCSE to go through before you actually get to actually get to the NHS pension scheme. So that may not have updated just yet. However, it will be in the process of being updated. Also, adjustments will be made to your pensions accordingly when it comes to actually the pension input as well. So you should have received a remedial pension savings limit, which we'll go through in just a couple of moments' time. However, if you are in, you may be in receipt of your pension already. If you are and you choose to keep the 1995 period, adjustments will be made to your pension payments accordingly, and any change will be backdated to the date of retirement. Also, that retrospective choice will also be offered to members that have taken early, ill health retirement, and to any families of members who have died during that remedy period as well, to ensure that everyone is treated completely fairly. You will make the choice of whether you so automatically you will move back into the legacy scheme, the 1995 or 08 scheme. However, you do have the option of keeping your pension in the new scheme, in the 2015 scheme, in the new scheme. Okay, that choice will be made by you at retirement. You don't make it now, you make it at retirement. If you opt for partial retirement, the choice is made on your initial retirement rather than your final retirement date. And there is actually quite a lot of information on the NHS pensions online, which does provide you good kind of calculations and what have you to work out what will be the best option for you in your individual circumstances. However, these can also be conversations that we have with yourselves as well as advisors to ensure that you are taking the best decision for you at that point there. A lot of people have asked that they may have paid annual allowance tax charges in that time during that remedy period. What I've seen No, I think 95% of the clients that I've seen remedial pension savings statements for, and I'm assuming the same will be for Ish as well, who's here with me. The majority of members have seen a reduction in their pension input, which actually has reduced potentially a tax burden from previous years. So, for example, if they pay an annual allowance tax charge, there may be in essence, a tax refund to come to that client there. And also, if you had a scheme pays annual allowance payment, then that also may be removed or reduced at that point there as well. It's not completely straightforward. However, and the choice between taking the 1995 and 2015 scheme or 2008 and 2015 scheme is very much an independent choice. However, it is quite easy to work out by way of simply figures that this situation here, if you're going to carry on working, will be better for you. This one won't be. And that is something that we can go through with you as well, should you so wish. So there is a digital service that enables you to, complete, in essence, complete online, whether you've got increased, reduced, or changes to any annual allowances from previous years. We were able to correct online 2019, 20, 2021, 21, 22, and 22, 23. And you can also apply for compensation for any tax charge overpayments for years 2015 all the way up until 2019, and also pay any tax due for the tax year 2022, 2023. Like I said, this is called your rollback. So earlier I mentioned about the remedial pension savings statement. In essence, the remedial pension, so this is a very wordy slide, but basically the remedial pension savings statement is going to be all of your year's pension input from the year 2010. And you'll be able to see very clearly the changes that were made in 2015. So you'll be able to see your original pension inputs, your newest pension inputs, and where you've previously had any scheme pays or annual allowance tax charges. And then you will be able to use that remedial pension savings statements to apply on the HMRC's digital service, apply for refunds for your overpaid tax charges that we discussed a little bit earlier. And you can also make applications for that compensation for any tax years between 15, 16 to 18, 19. Also, it will allow you to pay any underpaid tax charges that you may actually end up having for 19, 20, 2021, 21, 22, and pay your annual allowance tax charge for 22, 23. It is actually quite an intuitive system to use, not something that I'll often say about HMRC. So, definitely give it a look, have a look at it. And it is, all you need to do is fill in the figures that you've got from a remedial pension statement and go from there. You may not have it just yet. However, be rest assured it is on its way. And if you haven't had it, feel free to 100% email the NHS pension scheme to ask them the question, why is it not on its way? Why haven't you got it yet? And what is actually holding it up there? It may simply be a case of, if you haven't had one of your type 2 forms submitted correctly in a previous year or what have you, that may be preventing the NHS pension scheme PCSE provide you with up-to-date pension statements, etc. Like we said, from April 2022, everyone has joined the 2015 scheme, the Reformed Career Average Revalued Earnings Scheme, the CARE scheme. So what will happen now is you will have a build-up rate, which is 1/54th of whatever you earn in a tax year. So like we said, previously it was 1.4%, and then it was 1.8%, 87%. So now it's going to be 1.85% for every single year of pension that you earn within the NHS. Okay. That will be revalued upwards by the revaluation rate, which is currently CPI plus 1.5%. For example, if CPI was 2%, then the income that you have earned in that specific year, so for example, what year are we, 25, 26, so for example, the year 24, 25, if last year the CPI was 2%, last year's income will be increased by 3.5% at the beginning of the following scheme year, which will then ensure that that income you originally earned is still keeping pace with inflation. Therefore, your pension will still be keeping pace with inflation as well. If you leave the scheme, and especially if you take a break of more than 5 years, you will lose that additional 1.5%. It's obviously there to protect you, to protect your pension from inflation. However, if you leave the scheme, you'll keep the inflation, you'll increase by inflation. However, you will lose the additional 1.5%, which will potentially have some detriment to you when you come to retire. For the 2015 scheme, retirement is in line with state pension age. Anyone born after the 6th of April 78 has a state pension age of 68, and instead of it being a specific year, so instead of it saying, your pension age is 67, your pension age is 68, if state pension age does change, hopefully it doesn't, because I'm 30 and I don't want to be working up until past 68 to get my state pension. But if it does move, then your retirement date for your 2015 NHS pension scheme will also move as well. Big difference is, though, you are able to continue working and building up pension rights in the scheme up until age 75, with there being no maximum limit on the number of years of pensionable earnings. You are, in fact, able to receive a early retirement as well. However, your pension will be reduced actuarially by way of, depending on how many years early you take it, between 2, 3, 5% per year early that you take it. However, you will be obviously getting that earlier as well. If they are pension benefits, obviously they're going to be reduced because they're being paid early, and less contributions will have been paid as well. Like I said there, taking 1 year early is approximately 6% reduction. Taking it 5 years early is going to be a 24% reduction. Taking it 10 years early is going to be approximately a 40% reduction. So you are best placed, if you are able to not take this pension until that normal retirement age, but the option is there for you to change that. Obviously, 68 could potentially be quite a long way away for you, so it's all a case of making sure that you're putting things in place for yourself now to ensure that should you wish to retire that little bit earlier, and you don't want to access your NHS pension for because of the reduction that you would find in the NHS pension, it's a very good idea to put other bits and pieces in place now, whether it be private pensions, stocks and shares, ISAs, general investment accounts, to ensure that you can supplement an income if you decide to retire early without having to take your 2015 NHS pension. Minimum pension age from April 2028 will be 57. Up until then, it is age 55. You don't get a compulsory tax-free lump sum with the 2015 pension. However, you are able to trade some of your pension for some of a lump sum. So for every so if you have a £40,000 a year NHS 2015 pension, and you sacrifice £10,000 of that pension for a lump sum, you will be given a tax-free lump sum and the current tax rules of £120,000. So it can be beneficial, can be not, depending on your current scenarios. The maximum lump sum that they will offer you that you will be able to take will be about 4.28 times your pension. And in all three sections, the maximum tax-free amount that you can take is capped at 268,000. I think it's 250 or 350 pounds. And that is the absolute maximum you can take tax-free from all pensions across everything that you have. So your annual benefit statement, which will obviously have all of your information about what pension you've earned up until this point here and anything further. You can normally access that through your total reward statement portal, which the website is there. Or, if you do have access to an ESR, you should be able to access it through that as well. On the right-hand side, it will say, view my TRS, view my total reward statement. For anyone not in England or Wales on this call today, I'm not sure if anyone is, but if anyone isn't in England and Wales, then the Scottish and the
I'm good.
Northern Irish decided to do things slightly differently. So there is a different website there to access that there. It will show all of your benefits, both the 1995, 2008 and 2015
a bit annoying as well, isn't it? It's one of those visit days.
So the cost of paying into the pension scheme. There's lots of different rates, which we'll go through in just a moment. It's between 5.2 and 12.5%. The contributions are taken from your pay before tax, so you do get tax relief on any amount that you pay in. That isn't just, by the way, on NHS pension. If you're contributing to a private pension as well, you will also get tax relief on that. This is something that can be discussed as well in the future with ourselves, because we can kind of try and help you with, let's try and be as tax efficient as possible when saving for your future. Obviously, pension contributions being taken from your pay before tax will reduce the net amount of tax that you pay. However, it does depend on your earnings level, your contribution rate, and your actual personal rate of tax as well. Like I said, in England and Wales, the contribution rate is between 5.2 and 12.5% of your pensionable income. In Northern Ireland, it is between 5.2 and 12.5% as well. And like I said, Scotland like to do things slightly differently. They have a pension contribution rate of between 5.7 and 12.7% as well. The employers, your employers contribute 23.7%. So 9.4% of that is met centrally. The remainder is met by your employer. Some of you may be partners or willing to become partners, but obviously this is something that you'll be very well aware of as well. And 0.08% is charged as an admin fee and is used to run the England and Wales scheme. Pension membership is not compulsory. However, we do recommend it because the pension scheme isn't just the pension. The pension is also your sick pay, if you do have that, but obviously it's slightly different for GPs as well. And it's also death in service and ensuring that your family members are protected there as well. However, if you want to, you are able to opt out. Annualization. So to determine your annualized income, you're expected to pay a pension contribution rate determined by the amount of income you would have earned over the whole scheme year. If you've got type 1 or type 2 roles for the whole year, then you don't need to annualise. However, if you are solely a GP locum, then only the days which you work will count as pensionable service. And if this isn't for the entire pension scheme year, you will need to annualise your income across that. It's the annualised rate, not the actual rate, which will determine the pension contribution tier that you will be sat in there so far. And this is a regulation that does result in certain members having to pay slightly higher pension contributions than maybe they would have expected to if they were in that role full-time over a year or kind of over that entire year. However, it is also depending on whether you've taken breaks within that scheme year as well, which is obviously April to March. Your annual allowance is £60,000, which was increased from £40,000 in 2023. It does get reduced for those with higher taxable incomes. I have come across a couple of GPs where they have got very high income, meaning that they do have a reduced annual allowance from £60,000 down to maybe £25,000, something like that. For every £2 your adjusted income, if your adjusted income is over £260,000, which is in essence your net taxable income plus your pension contributions, if that is over £260,000, every £2 you are over £260,000, you lose £1 of your annual allowance down to a minimum of £10,000. You are able to utilise carry forward from previous years if you haven't utilised your full allowance in previous years, and also tax can be paid via self-assessment or scheme pays, as some of you may or may not know. Should there be a tax charge to an annual allowance tax charge to pay. The amount that you actually pay into your pension, so your 12.5%, for example, plus your employer contribution, whilst that might seem that's what you pay into your pension, it actually has no real bearing on what you pay in at all. It's more often than not the amount of pension that you've earned towards that year, and also factoring in inflation from previous years as well. And that figure there is what's called the pension input amount over that pension input period. It can be a little bit complex to work out, but it's something that kind of we do very regularly. So we do find it maybe a touch easier to work that out for you, but it's not what you actually pay in. It's what your pension input is, which counts towards your annual allowance. So like I said, if your threshold income, which is in essence your taxable income, is over £200,000, then that means we need to calculate what your adjusted income is, which is then your threshold income plus your pension input in the NHS pension, plus any private pension contributions that you've made in that time period there. If that there is over £260,000, then and if both of these criteria must be met, both of these criteria are met, then your annual allowance will be reduced, like I said, by £1 per £2 you are over, down to a bare minimum of £10,000. Anyone with adjusted income of over £360,000 or over will have a reduced annual allowance of £10,000, no less. Like I said, the lump sum allowance, so this is the maximum amount of tax-free cash that you are able to take in total over your life. And that is set at, I was pretty much slap bang in the middle, it's set at £268,275 as tax-free. If you have taken tax-free cash already, then another calculation needs to be done to ensure that you aren't exceeding what that £268,000 is. However, the reason why this has been introduced is because the lifetime allowance was abolished by the Conservative government a couple of years ago. So meaning that this maximum tax-free cash figure has been introduced. So just as an example, Dr. Jones, age 60, he's got his NHS pension or her NHS pension, £30,000 a year with £120,000 pension commencement lump sum. They've got a SIP valued at £430,000, of which she took £107,000 tax-free cash. She's taken her £107,000. She gets her NHS tax-free cash. She will then have a remaining £40,965 there. I'll be honest though, this example maybe isn't quite accurate because the NHS pension would be 3 times what her pension is rather than 4 times what her pension is. So it would actually be more like £90,000 rather than £120,000. If you haven't taken maximum tax-free cash already, you may be able to apply for a transitional tax-free cash certificate, which you need to have full records of all previous PCLS plus any other tax-free payments that you've had, and that will be issued to all registered pension schemes when an application is made. The scheme that you're a part of needs to be satisfied with the amount of, in essence, tax-free cash that has been used, with any benefits that have already been taken, to ensure that you are able to take the correct amount of tax-free cash in the future. So, flexible retirement. We've already kind of touched upon what flexible retirement kind of does could potentially look like, whether you take private pensions, private investments, private ISAs and what have you, to ensure that you have some form of supplementary income should you decide to retire partially. However, there are now a couple of different other options within the especially within the legacy schemes, that allow you to retire maybe a little bit early. So you can retire. You already knew that should have already known that you could have retired and rejoined, which means you have to retire, take your full pension, then return to work after a break of at least 24 hours, which will then allow you to rejoin the 2015 scheme to earn any further benefits. All members are now able to do that from April 2023. However, obviously, there could potentially be the need to negotiate a new contract of what have you, to ensure that you are able to continue working at your current place of work. However, the more common thing that I've done for a number of GPs now is partial retirement. So partial retirement is, in essence, they've taken their 1995 pension at their normal retirement age of 60. They were a little bit older than 60. They took their normal pension retirement at 60, taken their 1995 section, but they carried on working 3 days a week to ensure that they can carry on contributing to the 2015 pension scheme. In essence, the minimum requirements for you to be able to take partial retirement is reducing your pensionable pay by at least 10% for at least 12 months. And if you do that, you can carry on paying into your 2015 pension and you can go from there. It ensures that you still retain death in service benefits, you still retain any sick pays that you may have built up elsewhere and what have you. It's very much a positive that you've got there. Like we've said, it's not just the pension itself, it's the dependents benefits. As an active member, it's also the death in service benefits and the lump sums as well, should something happen to you at that point there. What happens if you're sick and you can't work? If you're unable to return to work, the NHS pension scheme may allow you to take either a tier 1 or tier 2 ill health retirement. Tier 1 is you can't do your current job. Tier 2 is you're unable to undertake any regular employment at all. What's paid out if you take tier 1 ill health retirement? Any pension that you've already earned up until that point there without any actuarial reductions for early retirement. The tier 2 that is paid out would potentially be your tier 1 pension plus a pro rata enhancement based on half of what you'd expect to earn up until normal pension age. So if you've got 20 years worth of service left, they might add another 10 years worth of service on equivalent to ensure that you do get a reasonable pension if you can't carry on working. Us and what does Chase de Vere do, and hopefully how can we actually help you? Hopefully we'll save you any time by going through everything for you and kind of pulling all of the information together for you at the start point there. Reduce any noise around it so you can ensure that you are actually getting the advice that you need rather than lots and lots of advice about lots of different things that may not actually be relevant to you. Be able to help you quantify your goals. Franco, I want to retire at 55. Right, that's fine then. Let's work out how that's actually going to be possible for you. And if it's not going to be possible, hopefully we'll be able to actually tell you that as well. And then maybe give you any hints and tips moving forward from there. What makes us different? All of you are individuals, therefore all of you deserve bespoke advice. We are what's called an independent financial advice firm, which means we aren't tied to any bank, any insurance company, any investment provider, any anyone like that. We don't have a Chase de Vere product. Our product is our advice, which means we are committed to finding the best possible product available for you on the open market. We've been dealing with lots and lots of different doctors over the last 20 or so years, whether that be F1s all the way up to retiring GPs, consultants, surgeons, and what have you. So we do like to think we are specialists in our field, and we've dealt with over 15,000 doctors over the years, and quite a lot more non-medics as well. We're comprehensive, so we will cover everything: investments, pensions, life insurance, income protection, inheritance tax planning, whatever it is that you potentially could need to plan from a financial point of view. We are able to do that for you as well. And we don't like to brag blow our own trumpet too much, but we are award-winning. We're often recognised by fellow professionals and independent judges across the board as well. As Katie mentioned a bit earlier, should you so wish to, you are able to book in a complimentary meeting with, maybe one of myself or Ish, and can be in person, over the phone, over Teams, at your surgery, at your home, at our office, wherever that is best positioned for you. Normally between 60 minutes and an hour and a half. However, we start to build a picture of where you are now, what you actually want, and we can then start putting a plan together for how best to get there in the future as we move forward. If you don't want to proceed, obviously, then that's completely up to yourself as well. It's very much an open sort of, right then, that's it. We've kind of had the discussion. Maybe we can't help you now. Maybe we'll help you in a couple of years' time. But that's what we are there for as we move through. And yeah, if there are any questions, please feel free to ask them now. I'm not sure if there's been any that have been mentioned in the chat as we go. actually, by the looks of it, Ish has been answering a few questions for us. However, if you do want to book a complimentary first meeting with one of ourselves, then please feel free to scan that QR code. Just jump on your phone, scan the QR code, and we will be able to get booked in for you pretty sharpish.
Perfect. Thank you so much, Franco. As Franco mentioned, there will be the opportunity to arrange complimentary meetings. So the QR code's on the screen. I've just also popped a link in the chat box function if that doesn't work for any reason at all. Ish has answered a couple of questions already throughout the presentation. So just final farewell from us, and thank you so much for tuning in and registering for the webinar today. It is recorded, I believe, so you'll get the opportunity to re-watch back. And thank you very much for your time today. Hopefully you found it very beneficial and informative.
And Katie, just to add that obviously everybody that's registered will get a copy of the presentation and the recording, because I know some people had duplicate meetings, so that will be kind of circulated after this meeting.
Perfect.
Thank you very much for joining us today, and enjoy the rest of your day. Thank you.